Good afternoon. Welcome to the Sequoia's presentation and investor market update today. My name is Marcel. I'll be presenting today. The presenter on your screen, I think, is wrong. Maybe a few technical glitches there, but I know I've met a lot of you over the years. And thanks for tuning in for a bit of an update. It's been a turbulent year. We're almost at Christmas. It's hard to believe it's already December, and another year's gone by, entering 2014. It's been plenty happen this year that has some things are relatively expected and others are completely out of the blue. So you're probably well aware of a number of those, including a U.S. government shutdown, which we haven't seen for many years. So and if not decades. So it's there's plenty of learning experiences that have happened over the last 6 or 7 years since the bull market the last bull market finished. But overall, I'll just kick off, get the compliance out of the way. So my name is Marcel Collignon, representing Sequoia Asset Management. Here to just give you an update on the markets and also just a brief on our latest investment offering for those that are interested in hearing about that. The Sequoia Asset Management, we hold an AFSL. We only provide general advice, so everything today is general advice in nature and shouldn't be considered a recommendation of any sort. And you should take into account your own personal situation before making a decision based on any information provided. All examples are simulations only, and historical performance is no guarantee of future performance. So just getting that covered off. I'm sure you've heard that plenty of times over the years as well. What's happening at Sequoia? Just as an update, Sequoia, you've noticed the rebranding that happened nearly 18 months or 2 years ago now, actually. But JBG Structured Investments has been the issuer of a lot of products in the past year, over the past few years. We've actually rebranded in the last couple of weeks to be Sequoia, changed name to Sequoia Specialist Investment, bring us in line with the group overall that we're a part of now, Sequoia Group. So we're now Sequoia Specialist Investments, and the rebranding and the naming is more aligned to what we intend to offer in coming years as well. Likewise, just as the website has changed, so we're now Sequoia SI, Sequoia Structured Investments, to track all the past investments and future offerings. The old website, any URLs you've got saved there will redirect, of course, but yeah, just for if you want to update your URLs or find that they are giving you problems, then potentially just revisit the page and re-save those. And also, just as an admin thing, our Melbourne office, we've relocated from South Bank, where we've been for a number of years, over up onto Collins Street to Rialto Tower. So coming in, it'd be good to see you at the new offices, and likewise in a different part of town, but yeah, a bit of a change. The old lease ran out, and we're in a new digs now, so it'd be good to see you there. Economic update. So it's a big week of data this week. You saw the RBA on hold as expected yesterday. CPI figures are relatively benign, and in fact, even at the bottom end of their sort of expectations, expected to be 2.25% in 2014 and 2.5% in 2015, that should say. So the outlook for inflation is fairly good at the moment, right over the RBA's hitting plate as far as comfort level between that 2 and 3%. So not a lot expected in the way of interest rate moves, either up or down over the next 12 months. But certainly it's more leaning towards, if anything, a lift in towards the end of next year, but it's highly unlikely. I'll cover that off more lately. But the RBA did meet yesterday. Don't meet again now until February, and they have held rates on hold. Growth expected in 2005, 2.5%. So not too bad, but certainly 2015 is a year of expected growth on GDP numbers, and when the economy really starts to hit its stride again. The Aussie dollar expected to fall further, and likewise will have a benefit to the Aussie economy, making all our exports a lot cheaper comparatively to where they have been, particularly when the dollar was over parity. Currently, we're seeing US 91 cents on the dollar, even a bit lower, I think, last night. But the RBA came out last week and have announced a possible intervention to push it even lower. Ideally, the Aussie dollar will be back around the 75 to 80 cents mark over coming years. It might take a while, but the RBA is flirting with the idea of further ways to stimulate the economy that aren't interest rate driven and more currency driven, potentially intervening with the currency to help push it lower and improve the economy with a slightly lower Aussie dollar. CapEx investment survey came out this week. Comes out this week. Planned investment spend. Sorry, came out last week. I beg your pardon. Planned investment spending has improved dramatically from a business point of view. The CapEx spend was largely on hold, basically as a result of a pause in confidence due to the government situation, the uncertainty around this Labor government, all the troubles that we had there earlier in the year. It hit its lowest ever levels in July and August. The last time the survey was done, as expected, it jumped with the change of government, a bit more certainty on the outlook, and certainly having a Liberal government in force again provokes a bit of confidence amongst business owners in terms of future capex spends. All good for an economy and certainly good where businesses are growing. Trade balance has improved, slightly stronger commodity prices, and a lower Aussie dollar has helped our trade balance over the last 12 months or so. So where we're at, we're in a period of very low interest rates, 2.5%, historic record lows on interest rates. It's taking a while to bite back into the economy, despite the low interest rate environment. People are still got their hands in their pockets, the mothballs in their wallets. They're still reluctant to spend. Christmas trading will be interesting to see what happens with the Christmas trading period this year. Has been very slow for the last couple of years, as you would have seen in retail sales numbers, or you may have seen certainly in the news. There is a potential there. I mean, interest rates are a long way below where they were a couple of years ago, and it has provided a bit of an uptick in certain areas of the economy, and it is starting to bite now, which is good and having the effect that the RBA wants, which is to increase spending and increase confidence. There is the potential that they may cut further. We tend to view that they're probably at the bottom of that cycle and they're likely to just sit on hold for a while and digest what's happening. As mentioned earlier, the RBA is flirting with other ways to stimulate the economy, such as non-traditional measures, being the intervention in the currency, but also the government coming in. There's a lot of fiscal spending to happen in infrastructure projects and so on over the next few years, which I'll cover shortly. But so that low interest rate environment is providing certainly a boost and a relief to consumers and investors alike. Unemployment still relatively good, 5.7%. It is on the increase slightly, as expected, in mining slowdown and so on, but it's still very much in the comfort zone. At the moment, 5.7% is quite palatable. And the main thing that's leading to it is improved confidence at the moment amongst retail, amongst the population, is the improvement in house prices over the last 12 months in particular. We've finally seen a bit of a bounce in property prices, most notably in Sydney and Brisbane, after being in the doldrums for a number of years, 6 or 7 years of really not doing anything, and and potentially going backwards a lot of, especially after inflation is taken into account. You couldn't give a house away in Sydney last year, and now you can't. You can sell any termite-infested, rotting dump for significant money, it seems, according to the paper. But having stronger housing prices, albeit only relatively sort of slightly above historical long-term growth, it just leads to that confidence in investors, that confidence to potentially spend a little bit more, maybe to do a renovation, maybe to go on a holiday, maybe to upgrade that fridge or that car. It just provides that confidence rather than seeing your equity go backwards. It just gives people that confidence to get out there and start spending, which of course has the snowball effect into the rest of the economy. So it's good to see house prices are positive in a number of major cities. Tony Abbott, new Prime Minister, it's a bit old news now, but just to reinforce that he does want to be known as the infrastructure prime minister. He's got a number of projects planned while he's in office, hopefully over the next sort of 2 terms potentially. But earmarked sort of $25 billion plus in spend on, in particular, roads right around the country. Everyone's going to get a benefit from it. Queensland, the Bruce Highway, East-West Link in Melbourne's going in, West Connect to complete Sydney's toll road system, the $1 billion upgrade of the Gateway in Brisbane, upgrades of the north-south corridor in Adelaide, and the Midland Highway in Tasmania, but also a major one being the completion of the duplication of the Pacific Highway, get rid of those black spots between Newcastle and Queensland, but just to improve that, one of the busiest corridors in Australia. It's a massive span, massive project, keep people employed for a long, long time, and develop an asset for the future, more importantly. As well as, on top of, really, I mean, a Labor initiative, we've got to give them credit for that as far as the spend goes, but the faster, more affordable national broadband network, it's going to be a major expense that is rolling out fast, and ideally it will create us a long-term asset, whether or not you agree with it, whether or not you agree with every farm in Australia getting a cable run to the house as opposed to just chucking a satellite. It's still a major asset completion and a major spend for the country that will hopefully boost growth over the next few years. But the infrastructure prime minister is getting in place a lot of deals. He's not just throwing cash away on the Harvey Norman television purchase scheme of the Rudd government, but it does get cash out there into the economy and also creates this long-term growth. So confidence is improving. We're seeing, it's interesting to look around in the city, or certainly in Sydney at the moment where I am right now. The number of cranes that have popped up in the last 12 months is quite noticeable. Even walking through Martin Place in the city, there's 4 buildings with cranes on them, and Martin Place has been fairly neglected for the last 10 years or so, but there's 4 major buildings being upgraded there. And it's significant spends from different companies. It's the old Donald Trump measure. He's been widely quoted on it when he looks out of the over the skyline. The number of cranes out there gives him a good feel of where the economy is at. And right now we are starting to see confidence, particularly from the property developers and companies expanding. There are a number of cranes out there. It's just an interesting observation. But confidence is improving as property prices continue to increase, and infrastructure projects are starting to take over as well from the slowdown in mining that I mentioned before, and hopefully that the infrastructure projects that are earmarked will pick up the slack from any softening in mining over the next few years. China, our largest trading partner, particularly where resources are concerned, GDP last quarter came out at 7.8%. I mean, this is a phenomenal rate of growth. They are still growing at a neck-breaking speed, albeit a bit slower than where they were a couple of years ago, but certainly strong growth coming out of China. So, and it's expected to continue as the urbanization of China continues over the coming decades. Australian population, long-term growth, has long-term growth impacts for us, of course, on a macro scale. Australian population is tipped to grow to 42 million people by 2050. The numbers came out last week in the press, you probably saw. 42 million. 8.5 million in Melbourne alone by 2060, so that's a pretty substantial increase. All these people are living somewhere and working somewhere is a big increase in population demand and overall economic growth potential. If we've got a doubling of our population in the next sort of 30 to 40 years, it's going to be a pretty big deal for our economy and help growth at a very much at a macro level. Infrastructure that needs to go in place, property that needs to be made available, all those sorts of things to deal with that population growth is where the general growth of the Australian economy is going to come from in coming years. Certainly will help with it. So where have we been? I mean, we refer to this chart every year. We get the refreshed version from the ASX, and just to highlight the fact that we have had a very turbulent 6 years. Everybody's well aware of the pain and suffering that we've gone through as share market investors over the last 6 years. We really want to highlight the fact that what we've seen historically is that during these times, it is tough to make a decision to invest, and particularly in shares where you can see the movements every day, the ups, the downs, the media getting excited about it. It's always good to just remind yourself about what's happened in the past. Of course, there's no guarantee of future performance, but it's certainly in the last 113 years or so since at least this chart's been published, historically we've generally seen some sort of recovery come after a bad spell, and we've certainly had plenty of bad spells in that 100 years or so, and some major falls. The last one, the fall since 2007 has been one of our biggest and longest recoveries. From an Australian share market point of view, one of the longest. We're approaching one of the longest on record. Many other countries in the world have recovered much faster. But always in history, throughout history, if you're looking back from prior to 2007, every time in history the market has recovered and gone on to some new high. We're seeing right now companies that are far more profitable than they were in 2007, far bigger sales and so on, yet share prices are still significantly depressed since then, and right now they're trading on very good multiples looking forward as a PE. The Aussie market in our value looks good and is expected to rebound. We've called it before, but we do expect it to rebound in the next couple of years to be back where it was in 2007. So we do remain very bullish on the outlook for the Australian economy. And how does that perform? The intro on the invitation to the webinar was around property, and the buzz around property at the moment. Everybody is really excited that property is finally moving. We get calls every day just finding out what we can do to help people buy property and super, which of course we can help do that. But what we always like to just remind people of too is that it's important to remain diversified to a certain extent, and just remind them that property does long-term property does have a great history of making returns. Right now we've seen one good year. If you're in Sydney, it's one good year out of about 6. So it's you've been holding for a long time. Hopefully you've been holding and didn't sell last year, but you're finally seeing some rewards for that. But if you actually look back over a long-term period of time, and long-term in 10 years, 10 years plus, AMP puts out this survey every year, and they'll put one out again actually next month. If you check out the papers throughout January, we'll find it as well. But they'll have another survey, and you'll see that the performance of shares versus property again come out. But over the long term, typically the Australian shares has maintained its number one status as the best performer over a long-term period of time, being 10 years. Even though we had that 50% fall in the Aussie stock market back in 2007 to 2009, despite that fall and including it, the Aussie share market has still significantly outperformed. If you had have invested $100,000 in December 2002 in the two that we're really focusing on here is Aussie shares and Australian property, being houses and units there, the orange line with the circles, you'd see that the median house price Australia-wide increased from around 100,000 to about 175,000 odd over that 10-year period. Not a bad return, certainly not a bad return at all. But you compare it to Aussie shares, and you can clearly see despite the fall, just holding on to that long-term investment portfolio of shares. The end of last year would have been around 240,000. Right now, the Aussie market's moved up around 25% in the last 12 months. So I don't know how it would have. I don't know where that one will look at the end of the year, but I'm very interested to see. So it's good to keep that in the back of your mind when you're thinking about when you're talking at your barbecue about how well your property's doing versus shares and so on. It's the shares do tend to historically have outperformed property. So it's important to have a balance, of course. Debunking the bears. Now, you're all tuned in to hear a bit about where the Aussie market's at and so on, and there's a lot of noise with the Aussie market, as mentioned, is up 20-odd% in the last 12 months alone, and we've seen it here a couple of times, and we've seen it pull back from here as well. So it's certainly safe to say that many people are nervous about where the market is, and we've actually got some data care of Bank of America Merrill Lynch here, just they're noticing the same thing, that investors are nervous about a potential correction that's that's coming, and we have seen it in the past. What's interesting to notice is that, well, look, there's a few reasons to be bearish at the moment. There's around 5 major ones that people are citing as their major reasons for being bearish or not wanting to participate in the market. The first one's that there's a correction coming. Now, sure, if you're looking to trade for a month or a day or a week, maybe it will. I don't know, but we're always more long-term focused, as you know, from being clients for a while. We maintain a long-term view, and you've got to see through the noise of the market. But right now, many investors are expecting that correction to happen. How big it is, if it comes at all, is not really sure. I mean, we've already had a bit of a pullback, as you've probably seen. But what's interesting is this survey of the sell-side consensus indicator that Merrill's published. They basically use it as their bearish indicator. Now, right now, the bearish indicator is lower than it has been, almost lower than it was in 2009 at the bottom of the market. The people are predominantly very bearish at the moment, expecting a fall, just simply because that's what they've seen over the last couple of years. However, historically, when this indicator is used, or when it's low or lower than the historical average, historically, the subsequent 12 months have resulted in a positive move. This is related to the S&P 500, a positive move over the next 12 months, and often the median return in that time has been 27%. So when people are predominantly bearish, or in other words, when everyone's selling, what's Warren Buffett says is time to buy. And right now, if you're using the bearish indicator as one of your tools, then potentially it's a good time to be looking at stocks despite the upward movements. So that's the first sort of indicator to give you some comfort about whether or not it's a good time to get involved in Aussie shares. Everyone is bullish. It's time to sell is the other bear call. So if you're not hearing people being bearish, you're hearing that your general view is, oh, the market's up, so everyone's bullish, and that everybody is buying, falling themselves over to buy. Well, I mean, that's not really the case. It's as we've seen from the bearish indicator, it seems the opposite, and we're seeing that at the coalface as well. People are nervous. They're going, oh, well, the market's 5,300. It's had a good run. Maybe it's going to pull back again like it has in previous years, potentially. But arguably, there's a lot of support there at the moment for the market, and a lot of interest in stocks that are performing quite well, and growth is expected to be quite good over the coming years. The popular bear call number 3 is that the 5-year bull market in the USA, anyway, is getting long in the tooth. Now, 5 years, yes, you are measuring it from the bottom of the market in 2009 till now as a bull market, but you're still got to compare it to its old highs. The US market has had a phenomenal run, and it's actually recovered it's now nearly 20% above where it was in 2007. So it's certainly well into positive territory. Australia's significantly lagged behind that, but I'll come to that later. But what's the more important one is to look at, well, people are saying, oh, 5 years, bull market, it's too long, it'll pull back now, we'll have some sort of major correction as per previous slides. But if you actually look at it, the average bull market has lasted 4.7% in the US, measured over the last sort of 60 or 70 years. The average return over that time has been around 165%, median 126%. Right now we're sitting pretty much bang on the average. The bull market's been running for nearly 5 years, 4.7 years, and the S&P 500 has returned 166% in that time. So it's pretty much bang on the average. If you look at a lot of the other ones. A lot of the other times in history, bull markets have run for significantly longer than 5 years, but also they've put on far more weight than this one has previously. Now, you've got to remember, too, this is one of the biggest falls in history. Often, too, and we have shown this slide before, that often following the biggest falls in history, you do get some of the biggest returns, as markets improve. So, look, what history tells us is we'll qualify this again. It doesn't always repeat itself, and in fact, it will never be the same as it has happened before. But there's certainly a strong case for a bull market to potentially continue, and the data that we're seeing shows no sign of any reasons why markets should fall substantially from here at this point. Popular bear call number 4: the Fed's about to take the punch bowl away. Yes, that's a good comment. It's been happening and certainly been priced in since May, when we saw that big fall in May after the Fed came out with their hawkish tones and telling that they're going to wind back stimulus. So far, they actually haven't done it. It was expected to be a couple of months after that meeting in May and when the markets got trashed, but they actually ended up changing their mind and continuing their bond purchase program of 80-odd billion a month. They are going to take stimulus away. There's no doubt about it. But right now they aren't, and they will do it on a gradual basis as the economy gets back on track, which it is, but not before. They're not going to jump the gun. They're very conscious of the fact that the economy isn't still fully recovered. It does need the support of the Fed, so it's not going to happen immediately, but it's certainly not going to happen all at once. The bond buying program, for example, the 80 billion a month, it may get wound back 10 billion a month, but it's still going to be there. It's not going to be turned off immediately. So that's certainly not going to happen. It's not going to happen for the next turned off completely for, well, potentially many years at this stage. So it will keep going, and it will keep help feeding that interest rate environment over there of near 0%. Second, and the fifth one, no, sorry, there isn't a fifth one. Back into the performance, and just to show you, one of the reasons, and part of this presentation we're highlighting, is the strength of the Aussie economy. We are, and the Aussie share market, the view that we have on the Aussie share market, we remain and are very bullish on the potential performance of Aussie shares over the next few years. And historically, just looking at where we have been in the last 12 months, again, we've underperformed the rest of the world despite having very good results from many of our companies. And yet we're still weighed down on a global scale. The Aussie market has had a good year. Look, you can't complain with 20% return. 20% return is great. It's an excellent result. You compare it to its global peers, the USA up 27%, nearly 28%. Dow Jones, this is from 12 months ago, not from the start of the year. Dow Jones up 24%. The DAX, Germany, up nearly 27%. The FTSE in the UK up 14%. The CAC 40 in France, 21.6%, and Athens, the Greek index of all index, I pulled it up just to show they're actually up 40%. So they've had so the rest of the world has enjoyed the benefits of growth too, but certainly in the majority of cases they've substantially outperformed the Australian economy despite the general strength of our economy and the numbers that are coming out of a lot of our companies. Put in perspective, the S&P, the ASX 200, the Aussie market still needs to go up nearly 30% just to get to recover to its old highs. Nearly 30%. We haven't even touched 2007 highs, and in 2007, we weren't even stretched at that point as far as valuations go if you compare us to the rest of the world. So it is quite strange that the Asia Pacific region in general hasn't really recovered as on a market, if you measure it by markets, as the rest of the world has. China, Japan, and so on. They're all well below those levels of 2007. Yet typically we've got economies without problems and certainly growing. So it is a strange phenomenon. Here's a chart of the German economy. You can see Germany's well past its 8,000 odd point high in 2007, up near 9.5 at the moment. The Dow Jones has smashed through its highs earlier this year, nearly 2,000 or more than 2,000 points above where it was in 2007, just recording phenomenal recovery, recovering significant. Same with the S&P 500, up over 1,800 points after peaking at 1550 or 1560 or so in 2007. We've seen substantial recovery, and indicating, the world is a pretty good place. From talking to the analysts over there, confidence is reasonably good, but certainly share prices, if you're using that as the measure, have compelled investor confidence over there. FTSE's broken through its highs. I mean, the UK economy, you can't exactly call that a buzzing economy these days, but the share market would tell a different story. The Dow Jones versus the ASX, and this is where I'm coming back to. Compare us to, and we called. I know a number of you have come to presentations over the years. In 2009 and 10, we were calling that the Aussie market would have recovered by around this year. We got it right on a few economies, being, well, pretty much all the economies you just saw. A lot of European and US economies have recovered, but for some reason the Aussie market just has lagged, and we can't quite put our finger on it. A lot of analysts can't put their finger on it either that we've spoken to. But the Dow Jones is now 18% above its 2007 high. Australia is 22% below its 2007 highs. We need to get to, in order for us just to catch the Dow Jones, to log the equivalent performance that they've had to date since their 2007 levels, we need to go up 50% from where we are, just to get back to where they are. It's around an 8,000 point equivalent. So it's sort of mind-boggling. The divergence between the two benchmarks, benchmark indices for the two countries continues to grow as Australia has remained relatively subdued. We've had a good year, no doubt, and we're certainly thankful for it. But the subdued performance over the last 5 or 6 years has been certainly noticeable when you compare the two, as we have here on this chart. Just how far we fell in the first instance. We fell more than the US initially, and likewise likewise on the way up, we haven't climbed as much yet. They were the ones with the housing problems. They were the one with the banks collapsing. They were the ones with all the problems. Yet we went through it without even going into a recession, and the Aussie market's still far lower than where it was. So even if the two were to catch up at the midpoint, whether the Dow Jones and the US economies and the rest of the world are too high, that's one argument, and whether we're too low. Even if we were to meet in the middle, that's some 30% gain from here. And over the next few years, that'll be a good result. This chart, we like to look at the how markets perform, and one of the big stimulus factors of an economy is interest rates. As you know, interest rates down at 2.5% has a massive stimulatory effect, or it should. It's finally sort of starting to bite in. Certainly we're seeing it on asset prices such as property, because you can't keep cash. At 2.5% per annum, you're going to go backwards. At the end of the day, unless if you're just sitting in cash, you can't stay there forever, because cash generally deflates against inflation. If you're only earning, well, assuming you can get the cash rate on an at-call account, you're at 2.5%. It's a lot different to where it was 3 or 4 years ago when you could get 6% in a term deposit. Right now, your cash accounts are paying less than that for at-call money. And that's the whole point of monetary policy, is that the RBA wants people to get out and spend money and do things and invest in assets and invest in business and so on, and grow the economy. And when they want to do that, they have to make monetary policy decisions that ease that cost. When they want to slow things down, they lift rates. So when economies are starting to run well and on their own steam, or perhaps even getting overheated, they want to cool things down by lifting rates and curb that expenditure, make you think twice about borrowing money to do it. And so it's interesting to overlay the two. If you have a look at the red line is the RBA cash rate over the last 20 years, and the blue line is the all odds. Now, if you actually overlay the two and you pick out historically the points where the RBA has entered their lifting cycle, so their raising cycle, they want the market to cool down, and right now it's arguable that it's not arguable, we are at the bottom of the rate cutting cycle. Sure, there might be one or so more cuts up their sleeves, but on a longer term outlook, I would expect that this chart over the next 5 or so years, you'll see that red line pick up and head north. The RBA, eventually the economy is going to improve, and these interest rates will lift. There's no doubt about that from every economist you probably read in the paper. That is likely to happen. Now, so the next major directional move, a sustained move, is likely to be up. If you actually look at that throughout history and what's happened and how the ASX relates to that, if you look at the ASX, so the first rate tightening cycle there, from 94 to 97, the RBA lifted where RBA lifted rates because the economy was starting to do well. You'll notice that during that same period of time, the ASX recorded a gain of around 38%. That's pretty good. The next tightening cycle happened in 2000 to 2001. The RBA lifted rates. They lifted rates by about a percentage point over the time, maybe a bit more, maybe 1.5% over that time. It was fairly aggressive, fairly quick move, as the RBA tends to do on the way up. The ASX moved 25%. And generally, why is that? It's because if things are good and the economy is humming, interest rates are going to be rising. They want to slow things down. If the economy is good and humming, sales are good for all these companies and so on, then the share prices are likely to benefit from it too. So it's not, they're related. The two are related in that if you use that as the yardstick and the economics the economic analysis of the two, it's heavily, interest rates heavily dictated by what the economy is doing. The next biggest rate tightening cycle, I beg your pardon, 2001 to 2008, where they finished that last tightening cycle. The market had one of its biggest 5-year runs for a while, up 110%. And again, from 2009 to 2011, when they started tightening rates again, they went from 3 to 5. It was very quick. I don't know if you remember it, but certainly we felt the impact of it, or the pinch of it, but mainly the cycle before that. But the ASX was on fire. It was up around 56% over that time. So things were good. What happens? Well, right now we're probably at the. I'd imagine that all of you would agree that we're probably at the bottom of this rate cutting cycle, and we're likely in the next little while, the next couple of years, to enter this rate tightening cycle again. Now, if that's the case, it means the economy will be in good form. And what's the ASX going to do? Who knows? History may not hold, but predominant over every rate tightening cycle in history, the stock market has performed well so far. Again, I'll caution it with history is no guarantee of future performance, but the average of those is 57%. So if we can get a 57% jump from here over that rate tightening cycle, then it'll be pretty good. So overall, the picture for the Aussie economy and the Aussie share market in our mind is good. We're seeing economists call there's one economist out there from Bell Potter, and they're actually calling 6,000 points by the middle of next year. Charlie Atkins, his name, he's well known for having called the top of the market. He's also well known for having called the bottom of the market in 2009 and getting people on board. Charlie is calling 6,000 by the end of the year. He's slowly becoming not alone. I hope he's right. 6,000 is a handsome return in that time. Even if it's before the end of next year, it'd still be a great result from here. Sort of some 12 to 15%. Upside from here, which would be great. Merrill Lynch recently upgraded their outlook for the S&P 500. They've increased their target, their 12-month target on the S&P 500 in the US is for a further 12% increase to 2,000 points by the end of next year. So overall, a lot of the banks and analysts at the moment are bullish, and we're bullish too. We believe the ASX will break through its previous high in the next few years, and certainly we're expecting that rally to be very quick once it does happen. So how do you take advantage of a recovery? Well, you can buy shares, you can do all sorts of things to get involved in the market. One of them is an offering that we have out there at the moment. It's called our Booster product. It gives the investors the benefit of a few things, including exposure to the ASX 200. Gives them a 3-year investment for the next 3 years, 100% limited recourse loan, so you can borrow 100% of the investment. You have an annual walkaway feature, so you can walk away each year. So you're only paying interest annually in advance, and after that, if the markets do fall, well, you can elect to terminate. So say they fall, and say they do fall 30%, it gives you the benefit, the ability to just make a decision a year at a time. At that point, we'd probably be suggesting that, well, perhaps you consider rolling down, as we have in previous offers, where we roll down and take advantage of the market being cheaper and structure a new investment to go with that. Competitive interest rates, 6.3% per annum, and there's a fixed coupon payable on this one of 4.5% per annum in the first 2 years that offsets against your interest. So your interest obligations, I'll come to a cash flow scenario shortly. And then you've got a final uncapped coupon at maturity, which is dependent on the performance of the ASX, so over that time. The reduced by your 2 coupons. So your 2 coupons are actually are being harvested from the growth, as a lot of our other structures are. So you at the end you get your final growth less whatever coupons you've been paid during that time. Volatility managed. Now, right now with the market with low volatility, we use a vol target technique that we've been using again for the last 4 or 5 years to help improve performance and reduce the hedging costs. But right now you're actually going in with around 140% participation to the ASX 200. So we can explain that a bit further one-on-one with you, just to run through and get your head around that. And more importantly, the ongoing management fees. Now, we do not like to charge ongoing fees, fixed fees, where we don't add value. We charge a performance fee. So we like to align ourselves with our investors and charge where we make money. Where we don't make money, then there's no performance fees payable. So ongoing, there's no actual fees to pay, which is something we've prided ourselves on, and we've lived and died by it sometimes. But unfortunately, but it does align us and investors to find what are arguably the most attractive investments and asset classes out there at any given time. And right now, we think that is the ASX 200 is probably the best place to be for the next few years. So these guys, John and Jenny, they agree and they want to get exposure to the Aussie share market over the next few years. Key things they're looking for in investment: they want some exposure to the Aussie market. They want to borrow, and they want to borrow at competitive rates. They want the ability to walk away if their circumstances change. Say in 12 months' time things have changed for them or market conditions have changed. They do want to be able to terminate. So they can do that, and they also want borrowing in a limited recourse lending environment. So they want an investment that's potentially suitable for their self-managed super fund or for their own name, but has limited recourse. So the only recourse they're ever exposed to is on the loan, is any interest that they've paid. There's nothing further to pay. The investment covers itself. 100% borrowing, so they don't. All they have to fund is the interest, and they want it to be simple. Income to offset some of the interest, and so on. So John and Jenny decide to invest $200,000 in the Booster Series 9 unit from Sequoia. This is how it looks. The first year of the investment, the cash flow as follows. They invest $200,000. They borrow 100% of the investment. So they borrow $200,000 from us. They pay 1 year's interest upfront in advance, 6.3%, so that's $12,600. They pay a one-off application fee, $4,400. The total upfront amount, therefore, is $17,000. That's the total amount they've got to pay for the first year of the investment, and that's all they're obligated to pay for the entire investment. If they choose to, after 1 year, they could elect to walk away. At the end of the first year, the cash flow looks like so. After 12 months, interest rolls around. They've been exposed to the ASX for the previous 12 months. They've got to pay their second year's interest, which is $12,600. They've got to pay a fixed coupon. Sorry, they don't have to pay that. They get paid a 4.5% fixed coupon, which is net of performance fees, so $9,000. Means the total outlay is $3,600. So on $200,000, they've only got to pay $3,600 next year to have that investment go for a whole another year. Now, at the end of the first year, if they don't want to pay that amount, they can elect to walk away, or they can pay the interest and continue the investment. Or, as I mentioned, if their circumstances have changed, or they just don't want to continue the investment, they can simply walk away. And the most they would have lost is the interest that they paid in that first year. The second year looks largely the same. The investment amount, $200,000, still the same, $200,000 loan. They've got to pay $3,600 out of their pocket to fund it for another year. But at the end of the year 2, again, the investors make the decision. They can choose to pay the interest that's due and continue the investment, or they can choose to, and they receive the fixed coupon when they pay that interest, which is set off against that obligation, or they can simply elect to terminate. Now, at the end of the third year, I'll run a couple of scenarios. Again, they're just for indicative purposes. Say the investment is up 40%. The market's just back above roughly where it was in 2007, a bit higher than where it was in 2007. Investors received the growth on that investment, less the gross fixed coupons that they were paid, which was set off against the interest, and any performance fees that were payable if there's gains. So the investment gains value at maturity, assume, let's say, a 40% gain. There's no indication of future performance, of course, but the investment would therefore be worth $280,000. Sorry, that's jumped onto the wrong line there. $280,000. They've got an outstanding loan of $200,000. They've already been paid $20,000 in coupons. The gross gains before the performance fees is $60,000. The net gain payable to them is $54,000. So if the market jumps $54,000, the net gain payable at the end is $54,000. Their return on their at-risk capital, and their at-risk capital is the interest that they're paid less the fixed coupons. That's the most money that they will risk. On $200,000 is $24,000. If they're investing $100,000, it's $12,100. If they're investing $50,000, it's about $6,000 is the total risk over 3 years. So depending what they do. The return on their at-risk capital, 123% if the market's up 40%. So that's a pretty good return. At maturity, though, say the investment is actually down. So let's say the market does fall 20%. They receive the growth on investment. They get to keep those fixed coupons that they've paid, and they pay any performance fees. Now, because the investment's down, there's no performance fees. The investment value at maturity will be $200,000. The investment has a fixed final price of $1 per unit, same as the issue price, essentially giving investors that capital protection feature, and in addition to the limited recourse loan, so that they can walk away from that investment at maturity with definitely no further obligations in addition to the limited recourse loan. So they use the investment to pay out the loan, nothing further to pay. They've paid $20,000 in coupons, which was set off against the interest. There's no gain, though, to pay out maturity, so the net gain is zero. They've basically, in that case, if the market's down 20% over the next 3 years, there won't be a return payable. But the maximum they've lost, they're not going to take a 20% loss on the investment in addition to the interest, as you would say with a margin loan, or if you were buying a property and it was down 20%, you had to sell it. The maximum they lose is that interest that they've outlaid and the fees. So the final value of $1 unit applies at maturity or greater, depending what the investment has done. But note these are examples only and not an indication. So you've got an upside performance and you've got a downside performance there, just to show you what the payoff could look like at maturity. Now, for those so that involves borrowing. Obviously, in borrowing, there you do risk your interest. If the markets go down, then unfortunately, just like any negatively geared investment, then you would lose your interest that you paid. However, what if someone doesn't want to borrow money to do it? Well, these guys, I forgot what their name is, Bob and Mary, want to get some exposure to the market as well, but they've already got significant gearing in their portfolio because they've got real estate investments, and they don't really want to borrow. Well, they're not comfortable risking the money. So the key features they're looking for is they want exposure to the market. They're bullish on the outlook for the economy. They've got the view that the Aussie share market is going to increase in value, but they want to make sure that they've got a similar amount of money in 3 years' time that they do now. So one strategy they could employ involves using high-yield cash accounts and term deposits at their preferred bank to offset the interest obligation. And I'll run you through a scenario. So Bob and Mary, they want to invest the same amount. They've got $200,000 to invest. $200,000, they don't really want to borrow. They don't want to risk that interest. What they can do is they can go and pick a term deposit. There's a few out there at the moment, Bankwest, ING, Rabo, big names that you've heard of. They're all sort of offering 3-year term deposits around 4.2, 4.3% at the moment. So what they could do, what Bob and Mary could do is they want to invest $200,000. What they could do is they could set aside $24,200 to cover the interest expense using the competitive rates that Sequoia is offering. and that'll cover their whole outlay over the 3 years. So the 3 years, they know that the maximum they risk if the markets all goes south is $24,000 on the Sequoia investment. But what that means is they had 200 grand. Now they've got 175,800 left in their account. So they've got the flexibility that cash is still there available for them. They could do something else, but one of the strategies they want to employ is they want to go and hunt down a term deposit and offset that risk. So they're happy just having their real estate investments in this investment. So they put 175,800 into a term deposit, 4.3%, hold it for 3 years. Compounded growth on that leads to a maturity value on that term deposit of $199,467. So basically, roughly, in rough numbers, similar amounts of what they started with, 200 grand. Assuming that interest is paid, regardless of the performance of the ASX 200 and the booster units over the next 3 years, the maximum risk then is $533 on that strategy, and their money is held with their favourite bank, and they're taking the credit risk on that bank. But additionally, they've then got that investment of 200 grand in booster, and depending on the performance of it, that'll also be paid. So it's not a recommendation guarantee of future performance. So that's one way that investors can, if they've got the cash, they don't really want to borrow, but they want to be exposed to the market. They'll know that in 3 years, depending on the bank they choose for their term deposit, in 3 years they should have broadly the same amount of money that they had in place when they started. Yet they've got the ability to invest in the market with the comfort and knowing that they'll at least have their money intact at the end. So there are risks, of course, with this investment, particularly if you are borrowing the performance. There needs to be positive growth, and it's got to be greater than your interest caps. The walk-away option, if you do walk away after 12 months or 2 years, there's no refund on the interest already paid, so it's designed to be held. It's not a trading instrument, it just does allow that flexibility that if you do have a change in circumstances or change in heart, you can actually walk away with no further obligations. So they are designed to be held for 3 years. Final performance fee coupon is based on performance. So that final amount, the scenario we ran on, it's based on the performance of the ASX 200. This is an investment for bullish investors. And people that think the market's going to go up. If it goes down, then there isn't the ability to make money out of this investment. But it does protect you from further losses. The participation rate at the date of the PDS was 140%. This participation rate varies daily. Sometimes it's less than 100%, sometimes it's more. Again, we'll run through that with more detail, and there's a lot of detail about it in the PDS. It just means that we're either going to outperform or slightly underperform the ASX, depending on what the participation rate does over the time. And it's a compulsory loan, so you need to be comfortable that you're borrowing 100% and you understand the risks of borrowing, even where the offset strategies are used. Gains and losses may also be magnified by use of a 100% loan. As you saw in the example, where you get a reasonable return out of the ASX, you can get a cracking return on your at-risk money, but also if the markets go down, then you can actually lose money and lose all the entire outlay. And so to recap, the investment gives investors exposure to the market. Tick, it meets that requirement that for those that are bullish, like we are, it gives you that exposure. Gets you a 3-year investment to exposure to the market. You got the ability to borrow 100%. You've got the walk away should your circumstances change. You're getting very competitive interest rates, 6.3%. You're getting a fixed coupon during the first 2 years as well, 4.5%. So that's guaranteed coupon to set off against your interest. The final performance at maturity, so you get paid a final uncapped performance if there is performance there. You've got the ability to have higher than 100% exposure to the ASX. You don't have any ongoing management fees. There's no fees to pay. Sequoia, we only charge where there's performance. And due to the competitive interest rates that we're offering, the term deposits can be used to offset some of that risk of that investment using that strategy we just ran through. So what have we seen? We've seen that everyone's sort of fearful at the moment. You look at the market. Where is it going to go? Who knows? But there's certainly opportunity. Opportunity is always around the corner, and it's important to be opportunistic when they do present themselves. Right now, we do see a lot of opportunity in the LZ market. There's a question box in the in your screen over there. What we want to do is actually if you've got any questions, just fire them. We should be able to type them away, and I can run through those over the next couple of minutes if you if you've got any questions about how something works or anything else for that matter, just pop them in that question box on your screen there, and I'll be able to get those. But likewise, what we'll do is also, if you want to be contacted and you haven't received the information, you want to organise a meeting one-on-one with one of our team, drop your name in that questions box and just put your phone number as well. We'll attempt to follow up and contact you. But this investment does close. It's got a fixed close date. It closes on the 12th of December, I think it is. So there's a couple of weeks to go. But as with all these things, we've got to get them set and get the investment going because of that capital protection feature, the way that the structure works with the fixed final value. We actually have to lock in a purchase date before, and then we'll have to do another series later in the year. So if you're looking to get exposure, we'd need to organise a meeting or a call if you prefer that just to discuss further. One of the questions is what's the minimum investment? $50,000, which requires an outlay of roughly $6,000 over 3 years, or upfront it's about $4,200 in the first year. So it's a good question. Are there any? No, you can invest, and you can invest basically any amount above 50,000. So if you want to invest $1 million or you want to invest 552,000, then that's no problem at all. The numbers just change because they're a simple percentage for your outlay. What's our target for the Aussie market in the next 12 months? Well, that's a tough one. Bell Potter's saying 6,000 by June. We're more confident. Our view is 6,000 by the end of next year, and certainly crack through 7,000 in the next 3 years to show a market recovery at the moment. So good question. Can I use my super fund? Yes, you can use your self-managed super fund. You've got to have a self-managed super fund to use it, but you certainly can. This is structured in a way that the lending is suitable for super funds, meets all the requirements as far as limited recourse lending and so on for super funds. So yes, you definitely can use your self-managed super fund for this investment. There's a question there from a Daniel, but Daniel, I actually don't know what hand raise means. Somehow you've raised your hand, and I don't know exactly how that function works. There should be a question that you've typed, but I can't see it. Hang on. Oh, hang on. Sorry, no, I've got it. Found it, Daniel. There it is. Yes, we are running the same webinar this evening, so if you have tuned in today, you don't need to tune in tonight unless you want to, unless it was a cracking seminar and you want to hear it all over again. You're more than welcome. You just have to register again on that from that email that we sent around. Okay, look, that looks like all the questions. Thanks for actually, Daniel, you've asked a question. Yes, that's right. Australian Eastern Standard Daylight Savings Time is 1 hour ahead of Brisbane. That's right. So in Brisbane time, that would be 6:30 your time, 7:30 our time for this evening's one. If you're suggesting potentially a friend is trying to get along to that, then yeah, tell them 6:30 Queensland time. Or for any Perth people over there, it would be 4:30 your time. Yeah, actually, Jeremy's just said that the registration should adapt for that anyway. I hope. Well, yeah. All right. Look, that's great. Thank you all for attending. Appreciate you taking time out in your lunch hour. We've seemed to have managed to squeeze it all into that. Do drop your name in there if you want to follow up, call or meeting, arrange a meeting. This investment does close soon, so yeah, if you could, it'd be good to hear from you. Thanks all for attending. We'll see you next time. Have a Merry Christmas and a Happy New Year if we don't talk to you before then. All the best.